Are you measuring the true impact of your Lean Six Sigma or any other improvement projects that you are running in your organizations? Understanding key financial metrics like return on assets, ROA, and return on investment, ROI, is essential for assessing the real value your projects bring to the organization. In this video, we'll explain how ROA and ROI apply specifically to improvement project initiatives, helping you quantify efficiency improvements and cost savings. Learn how to translate operational success into tangible financial returns and ensure your projects contribute directly to your company's bottom line. Let's dive into how these metrics can elevate your Lean Six Sigma strategy.
Project financial evaluation. How to calculate returns from a Six Sigma project investments. Here in this lesson, we shall discuss a few very widely used financial approaches for benefit capturing for any investments or expenditures. Financial evaluation is the process of comparing the financial benefits of a project with the financial cost. There are many concepts of analyzing this aspect. Here, in this lesson, we shall restrict our discussion to the ones that are in everyday use for evaluating Six Sigma projects. These are return on assets, return on investments, net present value, internal rate of return, and payback method. We shall divide these lessons in multiple sessions. The term return on assets, ROA, refers to a financial ratio that indicates how profitable a company is in relation to its total assets. The metric is commonly expressed as a percentage by using a company's net income and its average assets. Let us take an example here. Below is the total assets detail of 2017 and 2016 from the balance sheet of Epsilon Corporation's yearly financial statement. Note the differences between the two and how this will affect the ROA. The total assets for 2017 and 2016 were $450 billion and $430 billion. So, Epsilon's total average assets were for these 2 years were $440 billion. Now Epsilon's net income for the year 2017 is $27.5 billion. Follow the simple calculation here. Return on assets, ROA, equals to net income divided by total assets. In this case, we shall replace the total asset by average assets. So Epsilon's ROA equals 6.25%. This means that for every dollar in assets, the company earned 6.25 cents in profit. So for the ROA, the key takeaways are: you can calculate a company's return on assets by dividing its net income by its total assets. Return on assets, or ROA, is a metric that indicates a company's profitability in relation to its total assets. ROA can be used by management, analysts, and investors to determine whether a company uses its assets efficiently to generate a profit. For Six Sigma projects, the net income for a project is the expected earnings in a time duration and total assets that are applied to the project. And at last, while understanding the comparative results, it is always the best practice to compare the ROA of companies within the same industry because they all share the same asset base. ROI, or return on investment, is a performance measure used to evaluate the efficiency or profitability of an investment or compare the efficiency of a number of different investments. ROI tries to directly measure the amount of return on a particular investment relative to the investment's cost. The formula for ROI is net of current value of investment and cost of investment divided by cost of investment. Let us take an example here. For example, suppose you have invested $1,000 in your company Pizza.com in 2019, and 1 year later, sold the shares for a total of $1,500. Here, your net profit is $500. To calculate the return on this investment, divide the net profits by the investment cost and express as percentage. So ROI equals 50%. So for the ROI, the key takeaways are: return on investment, ROI, is a popular profitability metric used to evaluate how well an investment has performed. ROI is expressed as a percentage and is calculated by dividing an investment's net profit or loss by its initial cost or outlay. ROI can be used to make apples-to-apples comparisons and rank investments in different projects or assets. However, ROI does not take into account the holding period or passage of time, and so it can miss opportunity costs of investing elsewhere. If an investment's ROI is net positive, it is probably worthwhile to invest in that project.
Now we shall demonstrate the ROA and ROI concepts through a few numerical examples.
We shall see a basic numerical problem on calculating ROI. A Lean Six Sigma project costs $50,000 to implement. After 1 year, the project generates a total financial benefit of $80,000. What is the return on investment, ROI, for this project? We have learned that ROI equals to net profit divided by cost of investment. Therefore, as we see here, the ROI will be 60%. We shall discuss another example of asset utilization. A manufacturing company implemented a Lean Six Sigma project that increased its net profit by $120,000. The total value of assets used in the project was $1,500,000. Calculate the return on assets, ROA, for this project. We have learned that ROA equals to net profit divided by total assets. Therefore, as we see here, the ROA will be 8%. Now we shall discuss an example of ROI calculation with multiple investments. A company spent $30,000 on process improvements and another $20,000 on training for a Lean Six Sigma initiative. The initiative generated a combined revenue increase of $100,000. What is the total ROI for this Lean Six Sigma project? Here total cost is $50,000. The total profit is $50,000. Therefore, ROI is 100%. Now we shall see another example of ROA calculation, where asset value is changing. A project's net profit was $200,000, and the company's total assets increased from $2 million to $2,500,000 during the project's execution. Calculate the ROA based on the new asset value. Here the average asset value is. Therefore, ROA will be 8.89%. In our last example, we shall discuss ROI in a cost-benefit analysis. A Lean Six Sigma project has an initial cost of $75,000. It is expected to save $100,000 annually for the next 3 years. Calculate the ROI at the end of 3 years, considering only the first year's benefit for simplicity. Here ROI after 1 year of operation will be 33.33%.
End of the session.
To make the learning even more engaging, our research team has prepared a short quiz for you to test your understanding. You can find the link to the quiz in the description below. Take a few minutes to complete it and feel free to share it with your colleagues, friends and online mates. Before you go, don't forget to hit the bell icon. If you haven't subscribed yet, now's the time, don't miss out on the latest insights. I look forward to seeing you in the next video.